are officially live on YouTube. The Not Your Average Investor Show, doing the JWB Rental Property of the Week. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's a galloping cheetah. He's a great co-host. He knows how to generate cash flow. He's got genius concepts, and his name is Gregg Cohen. Say hello, Greg.
Hello, everybody. Great to be with you.
And with us, as always, the one that we call MTM because she delivers the moments that matters, and because her name is Madison the Magnificent. Say hello, Madison.
Hello, everybody.
And we welcome our audience live on YouTube right now. We welcome anybody listening to. We welcome you if you're listening to us in your ear in a podcast somewhere in the future. And if you're watching on YouTube later on, one of the things that we recommend, though, is to go to nyais.com, join the show live on a Tuesday or Thursday. It's a hoot.
It is
a hoot. It is a hoot. And part of that hooting that we do is a little tradition that we got around here. What's it called, GC?
It's called the roll call.
It's called the roll call, baby. All right. Welcome, Jenny Davis saying Guten Tag from Germany. John Henning, our usual leadoff batter, batting second today, saying good afternoon. The ringmaster of the Not Your Average Investor Show community, Drew Barnhill, saying good afternoon all. We got Leo Faraganan. Faraganan. Batting cleanup, saying good morning from Bay Area, California. We got Lee Bishop, the power hitter, the MVP of the community, saying hello, everybody. Greg Stone, the better Greg, checking in from New Jersey. We got Dean Curry, the early bird from Columbus, Ohio, checking in with us. Good afternoon, everyone. And we got the matriarch and the patriarch of the first family of the Not Your Average Investor Show, Ken and Carolyn Moline. We salute you. And we got John Moran checking in from Delray Beach. I love Delray Beach, man. You ever go down there?
I don't remember.
It's got this like crystal blue water. It's got good surf. I like Delray Beach a lot. John, welcome to the show, man. All right. We're good to go here. Everybody's talking in the chat, and I think once we finish the roll call, it's time for my favorite segment of the show, when Madison shares good news.
Hello, everybody. All right. Good news today is we get to hang out with some of you tomorrow. Tomorrow is our last of the year, so I guess that's not so good news, but the good news is we get to hang out with some of you. We actually have a full house coming tomorrow. We have Juliana and her husband, Danny, who are actually members of the show. I'm not sure if they're here today, but they're regulars. I see their names pop up. They will be here tomorrow. They've been clients since 2021. They own 2 homes with us. We have Russ, who's been a client since 2020. He owns 2 homes with us. Ellen has been a client since 2021, and she owns 1 home. And then Marianne is a PMC, for those of you that don't know PMC, that she owns properties that she's brought to us to manage, but she has also bought turnkey homes with us. So she actually has 5 homes under management with us, both turnkey and PMC. And then Donna, who is around often. We've seen her through the office a few times. She owns 12 homes with us. She's also PMC and turnkey. What I thought was super cool about this group coming tomorrow is everybody has been clients no earlier than 2020.
Oh, that's super cool.
Yeah. So everybody has been clients for 2 years now. So.
And I just think that's it's such a wonderful opportunity to meet clients that we haven't had the opportunity to do for the last 2 years because of the pandemic. And, prior to that, it was a big opportunity for people to become a client, right? Go through the onboarding process, right? During that process, you are working with us over the phone and we're having online meetings getting to know you, but we can't have that personal interaction.
Yeah.
So you put the homes under contract and everybody is invited to come to one of our client tours, which we have monthly. And then we even cover the cost for you. So it's an awesome opportunity, one that we definitely get excited about now, especially because the last 2 years, we didn't always have that opportunity. So can't wait to see everybody.
Fun fact too, Donna actually referred Marianne to us.
Oh, no way. Fantastic. Like a beautiful,
what is it?
Compilation. It's like it all comes together.
Mosaic.
It's like a cornucopia of goodness here. Here you go.
Just keeps getting better.
Love it. You know what? I think that's good news. Thanks, Madison.
Of course.
All right. And coming in late today, but on time, is Marilyn Cotterman from the beautiful Gulf Coast of Florida, a little place called Homosassa.
That is the home of the manatees.
Home of manatees. Good to have you, Marilyn. We also got Nadeem Shah in the house saying good morning, good afternoon, JWB family. And we got Hervé Francois in the house. Hervé, good to have you here, buddy. And David Bladner, who took a little longer walk with his dog than usual. So he's trickling in here late, just in time for we got breaking news, GC. What's going on out there in the world of breaking news?
We got some breaking news. I don't know if anybody's heard, but the Fed has been raising interest rates over the course of the last 3 to 4 months at a breakneck pace, the fastest raising of interest rates in the last 40 years. This is an attempt to quell inflation, and a very high priority for the Fed is to make sure that interest rates go higher to stop 20% home price appreciation in the housing market. And so with that, the end result of the Fed raising interest rates, it's not a direct relationship, it's an indirect relationship, but ultimately all of you who are buying turnkey rental properties have been seeing that the interest rates that you are getting on your loans, they're higher. We've talked about this for over a year, that this was going to happen and going to continue to happen. It shouldn't be a surprise to anybody, but I want to make sure I continue to keep you all updated, especially as it relates to the property evaluations, one of which we're going to look at here in just a few minutes for the property of the week. But what everybody should understand is that the interest rates are going up. So on your property evaluations, it used to show a 6% expected interest rate. Now it's 6.25%. Now here's something you might not be aware of, is that interest rates are actually a lot higher than 6.25%, right? But what a lot of our clients are doing is taking an opportunity to buy down the interest rate. And so while you might be out there hearing that interest rates are a lot higher than 6.25%, that's very real. They are higher than 6.25%, but what you can actually do is buy down the interest rate. Now for us, we've run the analysis and we include all of those costs. We just include the additional cost of what it would take to buy down the rate in the closing costs section of the property evaluation, which we can take a look at here. And this is, again, if you go back to a few shows, probably maybe 5 or 6 shows that we did in the past, where we were going through those top 5 ROI half truths that other providers just don't include that artificially inflate returns on investment. One of those was that they did not include closing costs. And so when you're looking at other evaluations, if you're not including closing costs and you see a rate that is somewhere below 7% right now, they're just not including a cost that really will affect your return on investment. Of course we do. We're going to go through it here. Your closing costs, for example, on this property are going to be somewhere around $11,000. If you go back, months in the past, your closing costs on this property might have been somewhere around $5,000 or something along those lines. So it is a real cost. It makes sense when you buy and hold this asset for the long haul to buy down the rate. And, I think the most important thing is that the numbers we put in front of you now are the numbers that we're going to hit because we take all these costs into account. But we'll take a look at it in real numbers here as we get into the property. But I want to make sure everybody understands that what the Fed is doing is continues to drive up interest rates. And, ultimately that does lower return on investment for us.
Not like if we didn't see it coming. You've been talking about this raising of interest rates. You started kind of saying when we went into quantitative easing, you're like, or when you went out of quantitative easing, you're like, all right, what's coming next is interest rates rising. It's going to happen. It's going to happen fast. It's been happening. It's been happening faster and harder than ever. What you've been saying of, cash flows starting to get compressed and ROI is getting compressed is happening still. We'll talk about the beauty of the asset class, but yeah, it's still continuing to go. And just the reality of what else are you going to put your money in when this is happening, right?
Exactly. Like let's be honest. This is not a fun thing that interest rates are going up for all of us as investors, but at the same time, there are other asset classes that are going to fare much worse than a slight decrease in your return on investment expectation when it comes to your rental property because of this. Yeah. So we need to keep perspective on all of this.
Got it. So while we've been talking, we've been joined by a couple of folks. We got Tony D in the house, Anthony Ditta from South Florida, and Henry Parsons, who I believe is a new name.
Is that a new name?
New name.
Henry. All right, new name.
Welcome to the show, Henry. Welcome. Happy to have you here. And as we always talk about, this is a community-driven show, so use the Q&A, use the chat to meet people. We already got some Q&A happening, GC, so I'm going to hop into that before we get into the property. And Lee Bishop, you may or may not have heard of him. He's the MVP of the community. He asks, Gregg, has the 1% or less drop in rent nationally hit JWB? Just curious. Have you noticed that nationally it drops every year at this time? Do you have statistics from the JWB inventory on the subject?
I do actually. I was just seeing an email update that came across our team this morning from our team who is actually tracking re-renting rates. So we track the rate that we had for a home before it went into a property turn. And then we track the rate that we're able to get for that home after a property turn. So not exactly what you're talking about here, but what it does is it shows a lot of positivity. We are actually re-renting our homes for 18% more than the rent that we were able to achieve earlier prior to the turn. So a very strong indication that rents are still strong here in Jacksonville. And to answer your question directly, no, we have not seen a drop in rents. In fact, not only have we not seen a drop in rents, we are not expecting a drop in rents. This story is starting to make more traction across the country. And I don't know enough about those other markets, but what I can surmise is that the data, just like there have been false representations of data when it comes to home sales, I would tread lightly with caution when it comes to rents, simply because rents typically are a lot more resilient even than home prices to effects of the economy. Like the idea that rents would actually go down is even more unlikely than home prices would go down in a normal economy. So, but you are starting to see some of this being reported. I don't know enough about other places, but I can tell you here for JWB, rents are not going down. In Jacksonville, they're not going down. And then, as you know, I bring a lot of our reporting to you from our consulting firm that we hire to give an objective analysis on the Jacksonville market, as well as other places in the country. And they're expecting 3.5% rent growth in Jacksonville for 2023. This was just released in the last couple of weeks. So they're expecting 3.5% rent growth for Jacksonville in 2023. That's actually higher than the historical norm. The historical norm is 3.3%. Across the country, they're expecting a little over 2% rent growth across the country. So yeah, so there you go. There's a little bit of different points of data, and no, I don't see rents dropping.
Yeah, so you can I guess this goes to kind of like two things when you talk about this. One is there is no national real estate market, right? Like information is localized. And so that's why, you know, one of the values of this show and values of access to JWB is the idea that you invest a lot in experts that give you, you know, local data, plus you have your data flywheel, you have the 4,600 properties that you manage. So it's all real-time stuff. So whatever you're hearing in the national media, you know, is not always going to be exact for Jacksonville because there's no national market.
Right.
And two, you know, the media is incentivized to get your attention. And as marketers, we understand that attention is easier to get when you are driving at a pain instead of a pleasure. So,
right.
You know, there's in the business model, we talk a lot about how the JWB business model is built to win when your investor wins. The media model these days is built on a click rate, you know, like it's per open, right? Like it's like per article of attention gotten. So it's not necessarily incentivized to win when you win as well.
Yeah. And I'm open to really great data.
Yeah.
And I don't care if that comes from the media, if that comes from JWB, if that comes from our community. I like really good data that also has perspective with it. And so wherever form that comes in, the problem is, especially with these sensational articles that are saying that we're in line for the next housing crash, just like it was 2008, you know, those articles may or may not have actual real data. And even if they give data, it lacks perspective. So there you go.
Cool. We got another great question here from James Lefbine. James, let me know if I'm pronouncing your last name correctly. That's a new name.
New name?
Another new name.
All right. Welcome to the party.
Welcome to the show, my friend. Hope you stick around here. James asks, if you buy down the interest rate and interest rates drop in a couple of years and you refinance, wouldn't that buy down be lost money?
You could. He brings up a good point, right? If you buy down the rate and then you refinance in a year or two, could you end up losing money on that transaction? You could. Right now, you don't know exactly what interest rates are going to do. We don't know how long inflation is going to be around. I would like to think that rates are going to come down as quickly as they've gone up, but you know, we don't know. So there's a little bit of a risk in doing that, but I think it's a good risk to take.
Okay. So it's like a hedge.
Yep.
Right. Okay, cool. That makes sense. When you deal with one of the JWB experts, when you're kind of like figuring this out, is that a question that can be asked? Like, hey, can you calculate kind of like, what is the amount of time that would have to happen for me not to lose money if rates go down and I refinance, something like that? Does your team qualify to do that stuff?
Yeah, absolutely. I mean, you can run that analysis. I mean, that's the beauty of working with us. When it comes to onboarding a client, it's a really slow process. And, you know, for some of our newer folks who might not be aware, we talk about a property of the week here. We highlight this really as a teaching tool for all of us here. If you are interested in the property and you haven't spoken with us before, it's not like we're just going to sell that property to you on the phone, like the first call, right? We're going to make sure that we're all set up for success here. And so through that process, a lot of great conversations about things even beyond, should I buy down the rate? I mean, it's an all-encompassing, making sure the table is set before we accept your money. And so this question would fall right in line.
And I think Raj is asking a very similar question. I don't know if there's any nuance here. If we refinance in the future, Raj, welcome to the show, buddy. If we refinance in the future, all the points paid to buy down interest rate will be gone. Is it really worth paying money to buy down interest rate when mortgage rates are currently high and likely to come down in the future?
You know, it's a very worthwhile thought and question. Our community is just really savvy. And so I think that we are playing with assumptions here, right? So if you happen to land on one set of assumptions, then we're going to be here to guide you on the way that you should probably go. And if you happen to land on a couple of a different assumption, then you could probably land on buying it down or not buying it down. So either way, we're going to look at this and say, okay, the end return on investment expectation that we want to perform for you is this based on you buying this down. Or if you decide to not buy it down, and your interest rate is higher and you're just expecting to refinance in a short period of time, well, then this is our return expectation. But either way, we just care about setting a return expectation for you and then hitting it.
Maybe we can play around with a sheet today like we haven't done in a while, but like conceptually, buying down interest rate, if I think about it, the purpose it serves is more to maintain monthly cash flow than an increase ROI long-term, or does buying down increase ROI long-term also?
You know, it's based on what do interest rates do in the future, right? It's based on two things, right? How long are you going to hold the property? But really it's how long are you going to hold the loan in place when we're talking about this? And if you think rates are going to be way down in the future, then you could refinance and you will have some costs to refinance, but those costs may not be as much as the buy down right now. So there's a lot of variables in play.
Got it.
You know, and so that's why it's like there's a hedge here. It's not like when you refinance, you don't have any costs that come along. You know, your refinance cost in theory should be less than what your costs are to buy the rate down. Yeah. But what do we know? What are rates going to do? You know, so we don't exactly know. And so there's, you know, it's not as set in stone that even though you think rates are going to come down in the future, it's not as set in stone that it might be the right move. It's based on timing. Like, when's that going to happen? How long is the loan going to be in place for? You know, so.
Cool. And Sanket Gupta's got a good question here in the chat. I think it's a good day to mess around with, like, fiddle around with a spreadsheet like we haven't done in a while. So we're going to dive into that. But Sanket, welcome to the show. That's a new name.
All right. Welcome to the party.
We got a bunch of new names today. So in that case, we are going to magically whisk ourselves away here to 6831 Miss Muffet Lane. It's in that fairy tale land of Jacksonville, Florida, 32210. We got a purchase price here of a property of $185,000. I'm going to come back to this, but that's lower than I've seen in a while. That's
the lowest property of the week. And I went back and I looked for like 6 months. Like, it's the lowest price property of the week that we've had.
Okay. We're going to talk about that. Monthly rent of $1,250. It's a 3-bedroom, 1-bathroom home. Completed status. It's obviously a renovated home here. It's rented. Annual appreciation rate, best in class here in Jacksonville, of 4.6%, and an estimated IRR of 11%. GC, what do you love about this property?
Well, I thought you'd never ask. I'll tell you what I love about this property. I think the first thing to bring to the attention of everybody here is that 11% internal rate of return, IRR, right? This environment, and I'm going to keep preaching this because this is the message that I hope investors get. In this environment, in this economy, to be able to get a return on investment that beats inflation without taking outsized risk and without having to be active to get that return is really rare. Like, I don't know where you get that type of a return without taking a ton of risk and without doing the work yourself. Right. So 11% returns on investment in this economy where you have the stock market in a bear market, when you have the bond market in a bear market, where you have all these other assets that are just not doing well and are not expected to do well going into recessionary times. This is something that stands out on its own and is unique. So that's what I love first and foremost about this property and all of our properties in our inventory. I will share that with you, not just this one. Beyond that, if I'm getting more specific about this home, look at this purchase price. Like I tell you guys, don't focus on the purchase price, focus on the return on investment, right? Because as investors, we are here, we are charged with using our capital to the best risk-adjusted return on investment. But a lot of us don't have the capital to be able to buy a home, right? We don't have $65,000 or $75,000 to be able to put down to buy a home. Or you may have a couple of homes and you want to be able to maximize that to a third home, right? Take that, set amount of capital and diversify your portfolio with multiple holdings. Well, when you have a low price property like this one, $185,000, flat out, that's just a great opportunity to do that. So for newer investors, for those who, are excited to dip your toe in the water and buy your first property with JWB, or if you're looking to expand your portfolio and you're really close to having the down payment, but you didn't think that you were there yet, this is one to take notice of. $185,000 significantly decreases your cost to get in. So in addition to that, there's something else. And I know we always talk about these rent credits, these buyer credits, right? When we were thinking about when I was thinking about what to title the property of the week this week, I didn't even talk about the rent credits because I ran out of space because I love all these other things. But rent credits are a real thing. So from time to time, JWB acquires a home that is under rented. And when that happens, what JWB does is we cover the difference between what it was rented for and what market rent is. And we credit that difference to you and we do it right at closing. And so for this property, the client who buys this property will walk away from closing with $6,000 of a buyer credit. And that is because that is the difference between what it is rented for currently and what it could demand on the open market. It's a way to create a win for the resident who does not have to leave, who does not have to be disrupted. It's a win for you as a client because now you're able to perform to those 11% returns, and it's a win for JWB. Even though we pay that $6,000, it's a win because we have an asset that's sellable. And so that's what this home has. This home is already rented with a long-term resident in place. Their lease goes through 2024. Nice. So got a lot to love about this property.
Yeah, lots of love. All right, cool. So 11% IRR is better than you're going to see in other asset classes, right? So that's going on across the JWB portfolio. Lower purchase price, like we said, we do this thing every week. It's been 6 months since we have a property that's $185,000, right? So that lowers the barrier of entry for folks, and the rent credit that is cash in hand just to kind of start the deal, right? So you're dealing with all upside. Love that. GC, we got some questions here. Ready?
I love it.
I think I really do want to bounce into the sheet, right? So Madison shared in the chat, but if you're listening here in the near future, you can go to jwbinventory.com, download the deal eval sheet of what all this is based on, and you can use it to break down any sheets that you want. So it was Senket that asked about, can that be modified? If you download that sheet, you're able to modify whatever interest rate you have or anything like that. So we're going to work through that in a second. GC, real quick, you mentioned these like rent credits because it's under rented. Does that mean that it's going to be under rented forever? What, are they, if it's rented for the next 2 years, is it under rented for the next 2 years, or am I waiting for the turn to happen before it gets back up to normal?
Well, some of these terms can be somewhat confusing or interchangeable, right? So the reason we do a rent credit is to make sure that you are receiving market rent from the time that you start to invest in this property. And so technically, right now, the lease of this home is $250 lower than what market rent is for this home. Market rent for this home is $1,250. So this home is rented for $1,000 currently. And so what we do is we estimate 2 years into the future, and we say, and this is just mainly to keep it simple and set clients up for success here. We just say, listen, we're gonna cover that difference for 2 years. And so $250 a month times 2 years gets you to $6,000. So when a client walks in here, there should be no difference as if this market rent right now was being fulfilled at $1,250, or for the situation that we've created where it's technically rented for $1,000, but you get the $6,000 check day one. In fact, there's more advantage to getting $6,000 day one to supplement the rent difference for 2 years than you having to wait 2 years to receive all of it. And plus, listen, 100% guarantee that the rent's going to come because that's their day one for you. So actually more advantages to receiving the rent credit, which is one of the reasons why I love it.
Okay. Are there clauses for like escalation in the lease? Like, well, what is to be expected there?
Yes, great question. So in addition to this, the standard way that we would approach a lease applies. And so what that means is for a 2-year lease that somebody signs, in the second year, they will see an escalation of rent somewhere between 4 to 6%. If somebody signs a 3-year lease, they're going to see that same escalation of rent, a rent increase after the first year, and that will go up from 4 to 6%. Then in the second year, it will go up as well, 4 to 6%, right? Now, for the third year of leasing, we actually hold that rent constant. So that's the win for somebody to sign up for a 3-year lease for us. The rent in the third year is held constant. So this resident, I'm not exactly sure when those rent increases would go in. If you have a question specific to that, get on the phone with my team. We have all that information. But yeah, but at some point, this would just be a regular lease and there would be a rent escalation in place. Again, as long as there wasn't that third year that they had committed to and, would be held constant just for that.
Got it. All right. Thanks for the explanation, buddy.
Yep.
We got James Hankins, new name, another new name. We got a bunch of new folks here. We love it, James. Yeah. He's asking, do you have any properties in Texas, DFW market, GC?
James, thanks so much for being here and for the question. And James, and for some of the other new folks, if you wouldn't mind just putting in the chat, how you found us?
Yeah.
We're always really curious here how folks are finding us.
Yeah.
And James, we do not operate in the Dallas-Fort Worth market. We actually are 100% committed to Jacksonville, which is a little bit different than most turnkey operators. But we really believe that being a vertically integrated turnkey company and focusing on one market actually produces the best risk-adjusted returns for you as a client. And so we're 100% committed to Jacksonville. We have no intention of going elsewhere. And the reason the Jacksonville market works so well is because you have low prices here, you have high rents, and you have higher than normal home price appreciation. So our home price appreciation compared, in Jacksonville, compared to markets like Dallas and Cleveland and Memphis and Kansas City and Birmingham, take the average of their appreciation over the last 40 years, and you look at Jacksonville's home price appreciation over the last 40 years, we have appreciated 24% more than those other markets. And so that's really the linchpin of long-term growth that you get here in Jacksonville. One of the major reasons that we are here and we're committed to be here.
All right. I think that answers it. Well, so you're saying lower prices, right? So this is while Jacksonville home prices have skyrocketed over the last couple of years and really has been an upward trend for the last 10 years,
Yep.
Still lower than the national average,
Yep.
While still maintaining these high appreciations, which leads to the best of both worlds, which is that positive cash flow position with also betting on appreciation, which at the end of the day is where you get the bulk of your money in rental homes, right?
Exactly.
Yeah. Cool. Thank you, Sanket. Thank you, Henry, for letting us know where you found this. Super, super valuable to us. I appreciate that. If anybody, anybody else wants to chime in on how you found the show, I would personally really appreciate it. So Jerry Ortega's got a question. What can an investor expect to need for down payment on this property? Will you cover the out-of-pocket investment requirements in this presentation? Will the sheet also provide projected cap rate on this property?
Sounds like a perfect segue to the sheet, buddy.
Oh, sheet.
Jerry,
Here we go.
You're living rent-free in our heads, Jerry.
Let's do this. Let's go. Let's get into this sheet.
I've seen this in a while. This is like old school.
I know, man. We used to, so everybody knows we've been doing twice a week show for 2 years now. Started the property of the week about like 6 months into it.
Mhm.
We used to always dive into the sheet, and we haven't in a long time, just to simplify. But with all these new names, this is great. I guess we should just go straight into analysis conventional financing, right?
Yeah. So let's take Jerry's question first and we'll kind of break it down.
Cool.
So, and this is a great thing for all of you. If you go to jwbinventory.com, this is here for you to download. And this is built as an Excel formula. This is built in an Excel file. So you literally can do the same things we're doing, which is super helpful for you to analyze this investment versus your other investing alternatives, especially in other markets.
We call it fiddling around with the numbers. You can fiddle.
We haven't been fiddling in a while.
We haven't fiddled. Gosh, feels good to be back on this fiddle.
All right. So Jerry, you asked, what can an investor expect to need for a down payment on this property? Well, if you zoom on in there, Mr. Pablo, and go up to that total initial investment, over to the left or right, whatever. There we go. Total, not so much. To the left a little bit. My left, your right. I don't know what we're doing here.
Total initial investment.
Yeah, there we
Gotcha.
go. Total initial investment. So that is comprised of your down payment, which is $46,000 estimated here, assuming you put 25% down. And then your closing costs, which would include the buy down that we talked about, which is reflected as $11,100 here. So your total initial investment here comes out to a little bit over $57,000.
For this condition, right? So again, we can also go into the sheet and we can mess around with this, right? So it was Sanket that asked, interest rates are a little higher, right? So let's say, what do you think would be a non-buy down interest rate right now?
Probably 7.5.
So Jesus Christ.
Yeah.
So 7.5. So we put in 7.5 here. And what ends up happening is IRR goes down, right? So monthly cash flow goes down to 5.
Not to be fair, your closing costs would also go down.
Closing costs would also go down.
Call that 5,500.
Oh man, I don't want to mess this up
That's okay.
afterwards. I'll control Z this in a second.
Mhm.
Okay, so IRR would still be up in the 9.8% if the closing cost goes down as well. Yeah. So this is just an example of fiddling. I don't know where I was going to go with this. What do you think?
I think this is fantastic. And for all of you who are like, well, should I, buy the rate down? Should I not? I think this is really great. I mean, we can help supply you with the information that we know right now. And then if you want to play the game of like, what are interest rates going to do? And, if they're going to go down, you can do that and you can make your decision. We're going to support you either way.
Where were we at before? 6.25?
6.25.
Yeah. Okay, cool. So back to homeostasis here, right? So just showing you how the numbers all kind of work out. If you're going to fiddle around with this some more, right? You get to see purchase price down here. You start seeing all of the costs by year, right? We talk about this IRR thing. GC, you want to, since we're here on this column of IRR versus ROI, you want to give that a quick explanation?
Yeah, sure. IRR is the accepted way that you should be evaluating a rental property investment, assuming you're going to hold on for some semblance of time. And that allows you to take into account the income coming from all 5 profit centers. And it also allows you to take into account the timing. And so it's really critical that you understand IRR before you make a decision to invest. I see a lot of investors right now that look at some really high inflated numbers, and that is just not accurate if you're going to hold on to this property for, longer than 1 year. And so a lot of times, and it's really sad because I get these evaluations, I look at them, sometimes I forward them to Pablo and they show, 25, 35% expected returns on investment. And just from a math, like financial accounting perspective, it's just not accurate. Like you will never show up 10 years later and ever hit those return on investment calculations unless you had like 5 times the normal home price appreciation than they have seen over the last 40 years. And you would have to have that 5 times the normal home price appreciation sustained for 10 years straight. Like it's the real loser here is everybody who makes the decision that does not understand IRRs because they're inflated. So return on investment largely just calculates what hits your bank account this year, and it calculates it literally for this year. So if you are thinking about things like evaluating home price appreciation into your return on investment, which you should, if you're in the stock market, you count on stock price appreciation to evaluate your decision. So in real estate, you should count on home price appreciation if you're investing for a full market cycle. But if you're doing that and you're using return on investment, it doesn't make sense, right? Return on investment, you can't actually use it unless it hits your bank account in year 1. If you hold on to the property for 10 years, even though it might appreciate in year 1, you can't count that for your return on investment calculation. So there's a little bit of the difference. Long story short, IRR is the way to go. It's how you should be making your decisions, assuming you're going to hold on for a full market cycle. It allows for variability and timing of the cash flows. And a lot of your profit centers do not happen day 1 or year 1. They happen over a period of time.
Yeah. So to illustrate a little bit of what GC is saying here, right? This is where you see that IRR live out here in this part of the spreadsheet. Year 1, you're coming in with this capital in right here. It's got the acquisition, which is the down payment, the closing costs, the net rental income is negative as a result, but your tax savings is positive. Then as you go through the years, year 2, you start getting some, what is this, tax savings here, rent and how the rental income affects. You start getting into positive as you get into year 8. And then in year 10, that's when this IRR play comes in, because you're factoring in all the things that you would factor in if you were actually cashing in for home price appreciation, right? The selling, the holding costs, the appreciation, the net rental income, all this stuff, right? So this is based on a 10-year window, hence the IRR. Did I do that okay?
I think so. Go up to the top there. I just want to check a few things here. Go over to the right. Let's see if all of our numbers are still, keep going to the right there.
Yep.
Keep going to the right. All right, cool. Yeah. So yeah, I think we did it right.
Okay, cool. There you go. Let's get into a couple more questions then. I'm going to go back to I'll just leave this up for now.
Cool.
Sean Fletcher asks, not being new construction, is there any concerns with insuring the property?
Well, I think what Sean is talking about is the fact that insurance costs for existing inventory, which is not new construction, are higher today than they have been in years past. We've talked about that on the show, and that's been an issue really for the last year or two, and we feel really good about that being solved in the future as far as insurance rates actually normalizing and potentially even coming down for existing inventory. New construction inventory, you don't have to worry about it. New construction has largely been unfazed when it comes to rising premiums. But here's the way to think about it. We now understand what insurance costs should be. Right now, they are the highest that we have seen for existing inventory. If I'm generalizing, they're the highest, right? And we think that over time, this is the way that things are going to operate, and potentially they may come down. As long as we know what the insurance premium is right now and we put it into the overall calculation, even though they're higher than what we want, if you can still earn an 11% return on your money year in and year out, you should be okay with it, right? So the way you win in rental properties that are existing, renovations, existing inventory, that I use that term interchangeably, is you have a lower purchase price, right? Your rent to price ratio is typically a little bit better. But you give up the fact that, your insurance costs are going to be a little bit more than if you were to buy a new construction home. So another reason why I'm agnostic between new construction and renovations or existing inventory, if I can use a certain set of assumptions that are validated either by our own experience or by actually getting a quote, which is what we've done for this home on Miss Muffet, and I can get to an 11% return for new construction or renovations, I'm good either way.
Got it. So basically what GC said in a long verbiage there is that insurance is already baked in here, right? So like this is high insurance, but it's already baked in. So it's accurate to your returns. And JWB makes their decisions based on this data, right? Like this data comes from real numbers. Like there's a lot of rental property investing companies that'll take a number from like an assumption spreadsheet and plug it in. This insurance number comes from Rich Insurance, which is the insurance agent that does all of the insurance over here. They're always putting in real live numbers into these things. And the rest of these numbers come from what we refer to on the show, since there's a lot of new folks, as the JWB data flywheel, right? Because they've been building and and property managing new construction and renovated properties in the same 4 neighborhoods in Jacksonville for the last 16 years, and putting all this stuff into a data flywheel that they have. All of the assumptions like the maintenance and the vacancy and appreciation rate, all these different things are true to the property itself in the state that it's in itself, because it's all based on historical data, based on 4,600 data points.
Yeah.
Yeah.
Well done.
Love that. All right. Shout out to Tara, the keeper of the flywheel. She listens to the show. All right. Sanket's got a great question here. Is it fair to say that right now, not buying rental property is more of an appreciation play than cash flow?
Sankit, great question. I mean, we've actually been talking about this for years and years and years before we landed in the place from an economy perspective that we're in. We started talking about this really when we started the show, and it was changing people's thoughts that buying rental properties with smart debt has never been about cash flow today. And I mean that when I say that. Buying rental properties has never been about getting cash flow today. Because if you just looked at the rates of return only from cash flows, and you looked at the amount of money that you would actually receive on a monthly basis, just from the cash flows for finance properties, is not going to change your life. Like you would have to buy hundreds of rental properties to get to the point that you would replace your income, right? Like it's never been about buying for cash flow today. Now it is about 5 profit centers. It has always been about 5 profit centers. Net rental income, which is cash flow, has always been one of those. Then there's tax savings, there's principal pay down, there's home price appreciation, and there's inflation hedging. And those 5 profit centers have always been the reason to invest in rental properties. Specifically about cash flow, you get some positive cash flow. That's great. It's not going to change your life. It wasn't going to change your life a year ago or 2 years ago or 5 years ago. It really wasn't going to change your life, right? But what it could do is if you bought with all 5 profit centers and you hold on for a full market cycle and you build up a nice portfolio of these rental properties, that cash flow can change your life in the future, 10 years down the road, as your homes might even be paid off or a portion are paid off, right? And your rents have gone up because of this inflation hedging and your interest payments have stayed the same, your mortgage payments have stayed the same. Like that's when it changes your life. So I don't think anything's really changed. I think, we're going to be normalizing the decision of buying rental properties, and those who understood the 5 profit centers back in the day, saw the value in this asset class and invested heavily in it, they really were rewarded over the last couple of years. But guess what? Everybody who makes that decision today to invest in this asset class, it's still largely the same set of expectations, right? Your expected home price appreciation rate over the next market cycle is the exact same one as when, Pablo, you bought your rental properties. You bought 3 over the last 2 years. Yep. And what I have shared with you is like, listen, buddy, you got a ton of appreciation out of the gates. I'm super happy for you, yep. But you're going to hold on to these things for 10 or 20 years. Yep. You're probably going to be at 4.5%-ish home price appreciation on average year over year over year. So I don't think much changes here. I don't think it changed in the past. I definitely told you not to invest because of home price appreciation only in the past. Yep. I told you not to do it for only cash flow. I feel like that's the message that is really applicable today as well.
This feels like a big moment for the show, Sanket. Thank you for providing this, because it's almost like we've been talking about this idea that you're not investing in this asset class for cash flow as long as I've been a part of this thing, right? And then we started realizing that that's not necessarily true. It's just that you're not investing in cash flow today. Right. We started introducing this idea of it's not about cash flow today, it's cash flow tomorrow, right? Like we use my dad as an example, right? Who has most of his wealth in the stock market now that he's in his 70s and he's living off it. And the stock market is going up and down, 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 down. It's affected his quality of life. Whereas if he had been putting that stuff in rental properties for this amount of time, his quality of life and his monthly, cash flow would be much less affected, right? So it's this idea that this is a bucket for our retirement planning that is the buy and hold, right? Like it's equivalent to the 401k. It's not money that you're counting on today to live on. This is money that you're counting on in the future to live on when you don't want to work as hard and you don't want to keep producing income and you want to live off this fixed income off of cash flow. And you don't want to have to make decisions based on the fact that there's likely going to be a recession at some point in your retirement. We're living longer and longer. And when recessions happen and the market dives 25%, that number that ING was promoting in their commercial that you had to get to retirement, all of a sudden got super, super compressed, right? Like,
unfortunately.
And that's happening more and more, right? So it's this idea that in 30 years, this home, the money that you put into it, it's only going to keep working for you. And then by the time you actually need that cash, it's much more stable. It's much more just there for you when you have a diversified portfolio of income properties. So like we hadn't really had that question come in from a new standpoint in the way that we've realized that it's what we've been talking about all along. It just happens to be more useful now to the conversation than ever before.
Well, and let's add a little bit more to this conversation, because you and I, for the answer to Sanket's question, has been from the lens of using conventional financing, using smart debt, right? One of the best things I love about this asset class is that this asset class can mean different things to different people. And if you are in the mindset of, this is the time to preserve my capital, and this is the time for me to have maximum income coming in on a monthly basis, you can buy these properties in cash. And then cash flow today actually shows up on a monthly basis. Whereas, in the stock market, you typically don't get a dividend, right? In the bond market, you get it every so often, but it's less of a return typically, less cash coming to you for the same amount that you invested, right? Less of that return on a monthly basis than what you would get if you bought these properties in cash. So this is a big part of our decision with clients and why we spend so much time, multiple phone calls with onboarding. It's because one size does not fit all. And if this is more about capital preservation and maximum monthly income for you, and you have the ability, the resources to buy in cash, that is also an extremely attractive asset to invest in compared to your alternatives. The stock market, which is down 20% and doesn't give you monthly income, or the bond market, which pricing is down over 20% as well and doesn't give you nearly as much income on a monthly basis. So.
Got it. James Leftpine's bringing up some good stuff here in the chat that I'd like to challenge you with because I have no idea what he's saying. By that, I mean, I'm not the expert here, James. Not that you're not bringing up great points. He says, assuming appreciation at 4.6% at this point, with prices and interest rates the way they are, is a very risky bet. Either prices or interest rates will go down in the next couple of years to get costs more aligned. If interest rates stay high, prices will continue to decline. Simple supply and demand will do that. What do you say to that?
James, I love the thought process. I really, really appreciate this being a forum to share, opposing views, and I just think our community gets better and better. And I think that is a very common thought right now. Here's where we build our evaluations, and our ideal client thinks this: I want to buy this asset and I want to hold on to it for a full market cycle. The beauty of investing for a full market cycle is it's less about what's going on in the economy today. It's less about what's going on with interest rates today, right? It's less about what is inflation doing today. And because we have the beauty of looking over 40 years in the past and seeing what trends do we see? And what you consistently see is over 10 to 20 year cycles, regardless of your market. This is not just Jacksonville. Regardless of your market, you're going to see a trend start to form. And that is that if you look at 10 to 20 year cycles of time and you look at home price appreciation rates in your market or my market, you're going to see that it comes back to the norm. So if you know that the average home price appreciation rate for your market is a certain number, it's 4.6% in Jacksonville, and I know that you want to invest for a full market cycle, I feel really good about over that full market cycle, your home price appreciation is largely going to be, call it around 4.5%. And so you may be right here with your opinion that interest rates are going to go way up and that home prices are going to decline. It's not exactly how I see it. You may be right with that, but the evaluation still makes sense, assuming you're buying and holding for a full market cycle. If you're buying and holding for less than that, then don't pay attention to this evaluation. Actually, probably rental properties, might not be the best asset for you, to be quite honest, right? Because you lose a lot of the profit centers if you don't buy and hold for a full market cycle. So I think it just comes back to the mindset of who is buying this asset. And again, our ideal client, and for me as a buy and hold investor, I own over 300 rental properties. I have been buy and hold since the very beginning. That's because when you buy and hold, you have the best opportunity to benefit from all 5 profit centers. And that's why you can feel really confident in the home price appreciation rate.
GC, is it worth bringing up that historical pricing data graph that you like to do to explain this?
Yeah,
or should we just go into these other questions?
Well, which one?
I don't know. Would it help you? Like Lee's talking
Oh,
about, should we bring up that graph? And
Oh, cool. Let's do it.
All right, cool.
Oh, you know what? That'll be really good too, because, and James hasn't been on the show, I don't believe, for the last, year or two. And something good to notice, James, is that we talked a lot about on the show about how home prices were going to appreciate more than 4.6%. But we did it all for the last couple of years. We knew that home prices were going to go up more than that. But if you look at our home price evaluations, our home price appreciation number was right there around 4.5%. Right? We wait until the data comes out to see the 40-year historical average to ever make an adjustment to what home price appreciation was. And it's because it's this commitment to the long term. So I hope that answers your question. Here's our historical home pricing data in Jacksonville, and this shows what pricing has done from 2001 till 2022 here. And what you see is the blue line are all the months of actual home prices. And that red line is the historical home price appreciation rate. And so you start to see a trend emerge that, you're going to largely follow that trend line. What many people, aren't aware of is that even though home prices dropped over 35% from 2007 to 2011, even though you had that drop, if you go from that time until the time we have now, guess what roughly the home price appreciation rate is, Pablo?
4.6%.
Yeah, it's roughly 4.5%. It took 10 years, 15 years, and then you got right back to the norm, which is the same thing that you're going to see for 20-year segments of time. And so that is just the foundation why I'm really confident putting an expected home price appreciation rate of 4.6% in front of you.
All right, there you go. So let's answer a couple more questions. Victor asks, any JWB investors considering any seller financing?
No, seller financing would be a way for you to buy if JWB was willing to hold the note for you. And we're not willing to do that. So it's not something that investors are doing.
Cool. And Sanka's Sanka's going to take us home with her final question here, asking, some of my current properties show very high valuation on Zillow. Are the numbers in the ballpark if I were to sell? What do you say about that?
Here's the thing. Don't make a buying or a selling decision based on an individual estimation off of Zillow. It's a cool data point. It's a cool starting point, but then go to a trusted resource. Sanket, I'm not sure if you're a client of ours. If you are, just reach out to your portfolio manager. Be happy to give you an evaluation there. If you're not, hopefully you become a client or you find, a friend that in real estate that that you can trust. I mean, these platforms, I think eventually will get to the point where they replace appraisals. But I've run the analysis. I've done some deep work with some of these platforms because there would be immense value to my business if I could just literally run a value, put an address in and get a value that I trusted. And it's literally not there yet. I literally have spent about the last month working with a provider different than Zillow, who's should have better data than Zillow. It's flat out not there. So cool data point. I think ask some more questions and reach out to a professional who can give you a better opinion. And if you really want to know, you can go down the route of doing an appraisal.
Cool. Sanka is a client, so Sanka can reach out to a portfolio manager and get that right thing. But let's do something right now, GC. Let's be our friend that's listening on the podcast, somebody that's passionately listening in the future. Let's be that friend in real estate to them. If I was to be considering, let's say, Sanket owns 3 properties. She's been a client for the last 4 years.
All right. Congratulations. Thank you.
If I were to be considering selling my property right now because the market's been awesome, what should I be thinking about? What is the advice that you would give to your dad if your dad was thinking about selling the properties after this historic run?
Well, my first question is, what are you going to do with the money when you sell?
Yeah. That's a big
Where's the money going to go?
Yeah. Where's the money going to go?
For most people, it's going to go to the stock market or the bond market, or it's going to go under their pillow. Either of those 3 options is worse than holding on to this asset that's probably performing really well for you. And it is goal dependent. It is highly specific. So I want to have that conversation with you. I hope you reach out to your portfolio manager. We have an entire team that's devoted to understanding
that makes sense.
What the right decision is for you. But that's going to be the first question that we probably ask you, because it makes no sense to just take the massive gains that you've got here to put it in a less good asset.
Yeah.
Yeah.
So what you're saying, GC, what I'm hearing is like, if you need the money right now because of something else that you're going to go put it in, right? Like it is a good time to cash that out or whatever. But if this is investment money that you're expecting to perform, like if you're going to spend the money on something because of a need or because of a goal or whatever, then that's the only reason why you would do it. If this was investment money to take money out of this asset class right now, you would have to be thinking, well, if I take it out right now, it's because I'm going to put it somewhere else, right?
That other asset should have a better risk-adjusted return on investment for you.
Correct. The other asset should have a better risk-adjusted return on investment. Right now, the stock market is not that asset. Right now, bonds are not that asset. So, maybe you have some inside knowledge on some deal. Maybe your nephew started the next Facebook and you're ready to let it ride with that or something like that. But it's not the decision to cash out just to hold that money is not a good decision.
Right. You should be able to answer that question for yourself, whether JWB asks you that question, I ask you that question, or somebody else, right? Understand how are you going to beat inflation without taking outsized risk and with being passive.
Yeah.
That's how we started the show. That's how we should end it. And I will just add one more thing. If that's from the investment perspective, But if you need the cash for something personal, there are still a ton of strategies for you to hold on to the asset because this thing's working for you. Hold on to the asset and still get access to the cash.
Yeah.
Right. I mean, if you do that, you get even better. You solve your problem of needing the cash for whatever reason, but you already have an interest rate that's lower than what it is today.
Mm-hmm.
Right. So why not keep that loan in place? Right. Your rents have already gone up tremendously while your payment has stayed the same. So you're probably making a ton of cash flow right now because rents have gone up so much. Like, you don't have to pay the taxes on the sale. You can just refinance, get access to the cash and save your tax bill. Like there's a ton that you can do to hold on to the asset if just access to the capital is the goal.
And realistically speaking, Senket's been in for 4 years, probably has a ton of home price appreciation, so a ton of equity. So you're basically just talking about cashing out equity via some kind of refinancing or via like a home equity line or something like that?
There's a number of different options, right?
Okay.
I mean, if we could keep the existing loan in place
Mhm.
and still get access to the capital, that would be ideal because her interest rate is probably lower since she bought in 2018 and started to buy in 2018 than it would be right now. But you could also make the argument if you got access to this capital, she's sitting on equity. We're assuming here she's sitting on a ton of equity,
Mhm.
which is a pretty good assumption since she's a JWB client for 4 years. I mean, you could run the analysis from a risk-adjusted return perspective and say, listen, I might be paying a higher interest rate today, but I'm going to get access to this amount of capital. I could put that to use. I could do private lending. I could buy a new property and then buy the rate down of the property today.
True.
And, or play the game of, I think rates are going to go down in 2 years and then not buy it down, save the money on closing costs today. And then, hopefully buy it down when it goes down 2 years. So a lot. And the key here is you got to talk to somebody who understands this stuff.
Yep.
Don't go at it alone. So
Cool.
We're here for you, Senkit.
Sounds like an opportunity for a show on all this stuff, which Gerard is calling for, which by the way, Gerard, GC just asked me to put together the Q1 show schedule. So thanks for that, buddy.
Help me help you, baby.
Yeah. Like, this is what I love about our community, man. They make our job easier by asking these great questions,
Awesome.
bringing the topics to the table. Whatever you all are asking for is what we're trying to deliver, which is why we do this live so that we have this interaction, we get the feedback and we make it as good for you as possible. Rapid fire to shut us down here. David Blattner, curious, is months of inventory increasing right now in Jax? Do you know, GC?
Yes, it is going up. Not as much as you think. It's 3.2, which is historically low. So yeah, rapid fire. I wish I had more time to get into that one.
Got it. We'll do more of that later. Jerry Ortega asks, does JWB work with any companies that offer self-directed IRA to purchase properties offered through JWB? What are financing options offered through JWB?
Yes, we love working with our self-directed IRA partners. Reach out to my team, Jerry. If you're a client already, reach out to the team. We can make that introduction for you. If you're not a client, go to chatwithjwb.com, set up a time to talk to my team, or just reach out to Madison right here. We'll be happy to facilitate a call for you.
All right. Madison is telling us to answer Mariana. What is it, Madison?
She just asked if we manage properties that she purchases from other people. I wrote her back, but I didn't know if she had seen it. So
Okay.
Perfect. Answer is yes. About a quarter of our properties under management actually come from folks, it sounds like you, who own a property and just want to get best-in-class property management services. And we love to perform those services, even if you don't buy properties with us.
There you go. So chatwithjwb.com to answer any of those questions, right? You can set up a call with a team. You'll figure it all out. If you are a current client, just talk to your portfolio manager. They're super helpful. I want to thank the community for making my job particularly easy today. Great questions, great interaction. Love having new folks. Senkit, you're the MVP of the call today. Welcome to the show. You've been a client for 4 years and you're just joining the show. I hope you make a habit of this because we love answering these questions. And Tuesday, we're talking about end of the year money moves.
Oh, that's right.
Right. We're just talking about kind of like, what are the strategies that add to this? If you're closing on a property, what does that mean for you these days? We might have a surprise guest, hasn't been confirmed, but it's an esteemed guest of ours that we're trying to get on the show. See if he's really. If not, you're just going to hear from regular old GC and me. But it's going to be a ton of fun. Appreciate you being here. It never goes unnoticed that on the middle of a Thursday, middle of your work, that you take an hour to hang out and make my job easy and make this so much fun and make friends with each other. Happy Halloween to everybody. GC, I'll give you last words.
Yeah. If you have ever wondered, why do so many people say you got to buy rental properties before the end of the year to get these tax savings, to get these tax advantages? Your CPA has said, yeah, I need to buy these rental properties to get these tax write-offs. I'm going to go through that with you. I'm going to walk you through, what do you get by doing that before the end of the year? What do you not get? Like, what's just the hype that's not real?
Yeah.
We're going to go through all that. So if you have any questions, make sure you're here on Tuesday. It's going to be a great show. And beyond that, thank you all. We were just talking about the quality of the questions and the chat before the show. We're like, man, I just feel like this is just working better and better and better. And today was just an awesome example of that. So thank you all for making this show what it is. We love you, and we'll see you on Tuesday.
Yeah. And little spoiler alert, GC gets excited when he talks about taxes. So join us on Tuesday for not an average show. See you soon.